Good afternoon, good morning. My name is Sofia Melis and I'm OMFIF's Chief Revenue Officer. I'm delighted to welcome you and our partners to the launch of the 2023 edition of the Global Public Pensions Report. It's a real pleasure to see these data developed into a time series after contributing to its inception in 2020. It dovetails with our GPI report to present a universal portrait of the direction and intentions of public money, as one of our asset manager partners succinctly put it. Thanks to Neuberger Berman, Lane Clark and Peacock, and ILX Management for their support and contributions to this year's edition, where we're proud once again to bring together the views and expertise of private sector practitioners with some of the world's most important public sector investors. The 2023 edition of the GPP report is based on a comprehensive survey of 22 global public funds with combined assets of $4.3 trillion, with particular focus on the investment strategies that they are deploying to build optimal investment in a choppy market, determined by an interest rate environment which was unimaginable only 2 years ago. My colleague Taylor Pierce, Senior Economist at OMFIF, will present the report findings in a moment, which will take you through the details and nuances of our key conclusions, which are: funds are adjusting to higher for longer rates, infrastructure is the asset class in highest demand, India is the most attractive emerging market, funds are ramping up their sustainable investments, and active engagement is urgently needed for the real-world transition. Some of these findings may be already intuitive, perhaps, but given the weight of public sector money, they will, needless to say, make a big impact on markets. After hearing about the report key findings, my colleague, Nikhil Shangani, Research Managing Director at OMFIF, will further explore these themes in a panel conversation. We would like to hear your views, so please send your questions and remarks through the chat function. I hope you enjoy the presentation and the panel discussion, and go to omfif.org to download and read this year's GPP report. Over to my colleague Taylor now. Thank you for the thumbs up.
Yeah, sure.
Hello and welcome. Thank you, Sophia. Thank you all for joining us for the launch of our Global Public Pension Report. My name is Taylor Pierce. I'm Senior Economist at OMFIF, and I've been working on this report for the last several months. It's a pleasure for me to walk you through the key findings of this year's publication. If we can move to the next slide, I'd just like to start with a bit of background about the publication. GPP sits under the flagship series of our flagship research series, Global Public Investor. We published the first iteration of this report earlier this year in June, which was a survey of central bank reserve managers. This publication draws on surveys, on bespoke survey discussions and written contributions from 22 public pension and sovereign funds across the world with combined AUM of $4.3 trillion. This includes 16 survey contributions from funds with nearly $2 trillion in AUM. We also rank the top 50 public pension and 50 sovereign funds globally by AUM, which our research is supplemented by the analysis of annual statements. The thematic focus of this year's report is on the macro environment and investment strategies, asset allocation, and ESG and transition finance, featuring some of the key findings from OMFIF's Transition Finance Summit in Singapore earlier this month. Moving now to the main messages that emerged from our research. I'll go to the next slide, please. The aggregate AUM of the top 50 public pension funds and top 50 sovereign funds globally are seen in this chart. The light blue bars represent the aggregate AUM of the top 50 public pension funds, and the dark blue bars represent the top 50 sovereign funds. As you can see here, after several years of growth, aggregate AUM of the top pension and sovereign funds stagnated last year, shrinking by 0.5% overall. This was mostly driven by pension fund losses. Nearly 2/3 of the sample, the top 50, suffered losses last year. And this is because they were more exposed to traditional asset classes like fixed income, which were negatively impacted by high inflation and high interest rates, which weighed on valuations. In contrast, sovereign funds fared slightly better overall last year, with aggregate AUM growing from $11.3 trillion last year to $11.6 this year. Particularly, funds in the Middle East drove the largest gains among sovereign funds, having benefited from the windfall from the rise in commodities prices. Our survey also showed that it will be a long road to recover 2022 losses for some funds. Half of the sample we surveyed anticipates that it will take over a year to recoup 2022 losses, while nearly 30% anticipate that it will take 2 to 5 years to recoup 2022 losses. And if we move to the next slide, we can see that funds are not just concerned over short-term challenges. We asked survey respondents what are the most important economic challenges affecting your investment approach over the next 5 to 10 years. We see from this chart that over 60% selected equilibrium, real interest rates, and inflation as the main factors shaping their long-term investment strategies. The share concerned about interest rates has nearly doubled from last year over the long term. And this indicates that a larger share of funds are becoming worried about persistently high inflation and, as a result, higher interest rates. And if we move to the next slide, we can see that these concerns are being filtered into their investment strategies. In addition to the survey data and the desktop research, we also feature a number of written contributions and interviews from various public pension and sovereign funds in the report, including Singaporean fund GIC and Australia's Future Fund. In their contribution, GIC writes how a more volatile macro environment is leading them to adopt a more granular total portfolio approach that blends top-down analysis with bottom-up insights. Similarly, Future Fund writes that they are moving away from traditional portfolio construction to take a more active approach and seek higher alpha returns as beta returns become more uncertain. As a result of these paradigmatic shifts in the macro environment, we also saw this trend in the annual reports as we conducted our desktop research of the top 50 public pension funds. This is exemplified by a quote of CEO of the Ohio Public Employees Retirement System here, who says in their annual report, "One thing is clear, the investment strategies that worked over the last 10 years may likely not work over the next 10 years. So what does this mean for asset allocation strategies? If we move to the next slide, we asked survey respondents, over the next 12 to 24 months, do you expect to increase, decrease, or maintain your allocation to the following asset classes? The chart here shows the net share of respondents in terms of their investment expectations. The light blue bars indicate the share of survey respondents looking to increase their allocation to the following asset classes. The dark blue bars represent the share of survey respondents looking to decrease their exposure to the following asset classes, and the gray diamonds show the net share of respondents. There are 3 key main messages to this finding. If we start at the top, we can see that a net 40% of respondents are looking to increase allocation to infrastructure, making it the asset class with the highest demand for 2 years in a row. Moving slightly down, we see that funds are also looking to increase their exposure to inflation-protected assets like inflation-linked bonds and commodities. The second main theme is that some riskier assets are back on the table, like corporate bonds and public equities. And finally, moving toward the bottom of the chart, we see that there's a net negative demand for cash and conventional government bonds. In addition, we see that this year shows a net negative demand for real estate, with a net 13% looking to reduce exposure to real estate. And we can understand this in the context of these 3 asset classes being sensitive to being rate sensitive. So with these 3 findings, they're consistent with the expectations of funds of persistently high inflation and a higher for longer rate environment in the coming years. In addition to shifts in asset allocation, we also see shifts in attitude toward regional allocation. So moving to the next slide, we asked the funds we surveyed, what is the most attractive emerging market? Nearly 40% said that India is the most attractive emerging market, and this is compared with just 23% stating Brazil and 23% stating China. We also feature a written contribution from India's National Investment and Infrastructure Fund, who explain in their piece how the Gati Shakti initiative is bolstering information sharing, transparency, and governance to improve India's appeal to global investors. And they say in the report, improved coordination among stakeholders and enhanced transparency in project execution may further boost the confidence of global investors in increasing allocations to India. In contrast, we see hesitation this year on China. None of the funds we surveyed has a positive outlook for the Chinese economy this year, and none of the funds we surveyed expect higher relative returns on Chinese assets. This can be understood on the next finding, which is 73% of the funds we surveyed listed regulatory environment and geopolitics as key barriers to investing in China this year. Moving to the next slide, we come now to another key theme of this year's publication, which is the continued drive toward green and sustainable investment. We asked funds which we surveyed, do you plan to increase, decrease, or maintain your allocation to the following sustainable asset classes over the next 12 to 24 months? We can see that across a wide variety of sustainable asset classes, there is positive demand to increase exposure to these asset classes. Particularly popular among those we surveyed are green bonds and green real assets, which include sustainable infrastructure, for example. We see that over a third of survey respondents expect to increase their allocation to green bonds and green real assets in the next 12 to 24 months. We also asked more broadly, how the green transition is affecting funds' investment plans, and nearly 80% of respondents stated that they are increasing investment in green and sustainable industries, which is the highest share. Moving to the next slide, we also see that a majority of funds, 64% of respondents, are increasing investment in transitioning industries as well. This is not an easy feat, and it requires funds' active engagement and stewardship of investee companies. This is exemplified by the quote here, which was mentioned at the OMFIF Transition Finance Summit in Singapore early this month. The CEO of Asia Asset Management of APG stated, "You can make your portfolio green just by diverting your flows. The hard work is in helping companies make this transition and have a real world impact." And beyond the added challenges that come with transition finance, transition investments also need to be solid investment on their own and deliver return. This is also shown in CDPQ's contribution to a report where their head of Europe stated, "We're looking for deals where there is a meeting of ESG and returns, and we don't accept lower returns just to comply with ESG targets." So we see that transition finance is a quickly growing area of interest for public funds, but it does not come without its challenges. Moving on to the next slide, just to conclude, I'd like to reiterate the key themes I've laid out here, which are, first, funds are reassessing their investment strategies in anticipation of persistent inflation and a higher for longer rate environment. Second, we see that asset allocation strategies favor infrastructure, while investments are being shifted away from rate-sensitive asset classes. And finally, funds are looking to ramp up their ESG investments, and active engagement will be needed to drive the sustainable transition, working to decarbonize the real economy and not just portfolios. Moving now to final slide. Thank you very much for your attention. Be sure to download the report to check out the back tables where we rank the top pension and sovereign funds by AUM, including geographic breakdown as seen here. And there's a lot more content. You can explore all the themes I've laid out here more in depth. And with that, I will now hand it over to my colleague Nikhil, who will kick off the panel discussion. Thank you very much.
Hi, everyone, and thank you to my colleague Taylor for succinctly wrapping up the key findings from our report. Over the next hour or so, we'll be delving a bit deeper into the findings and get the thoughts of some of the industry experts and practitioners. So I'd like to welcome my panelists. So we have Torbjørn Hanmark, the Head of Strategic Asset Allocation at AP3, Abdul Santiago, Chief Executive Officer at Fondo de Ahorro de Panama, Jahangir Acker, Head of Official Institutions at Neuberger Berman, and Mark Watts, Partner at Lane Clark and Peacock. And later on, we'll be hearing from Elvira Erdings from ILX. So just some housekeeping just before we dive into the discussion. So we want to make this session as interactive as possible. You'll hopefully see on the side of the screen, for those of you in the audience, there is a question box on Slido. So please post your questions throughout the discussion, and I'll try and turn to as many as I possibly can during the discussion. But let's start with what my colleague Taylor initially described about the macro environment and some of the pension funds and sovereign funds concerns and thoughts, and well, perhaps fears in some cases as well. And Torbjørn, I'd like to start with you on that. So we saw from those we spoke to and those we surveyed that equilibrium real interest rates is the most important factor affecting investment approaches over the next 5 to 10 years. 63% have it in their top three. Is that something that resonates with you? Is that the key issue for you in how you're thinking about investments at AP3? Or are there other macro factors, say inflation or geopolitics, that are the forefront of your mind right now?
Hi everybody. Good morning. Good afternoon. No. I think your respondents resound what's on AP3's minds as well. I think for a long-term investor, it's of course a significant shift that short-term and long-term interest rates have moved higher, and both well, maybe primarily in the real interest rate space, maybe not so much in long-term inflation expectations. That will make it a lot easier for us to construct an efficient portfolio. I do know that we debate a lot whether the higher bond yields and the treasury markets, etc., will be diversifying exposure or not. But I think there is a good chance now, when we see inflation stabilizing and the central banks cooling down a bit, that your bond allocation will be very efficient from a long-term portfolio diversification perspective. So I am a bit surprised to find the survey finding that people will move away from interest rate sensitive exposure. But of course, that depends a bit on what you mean. I'll stop there for now. Thanks.
Thanks. Yeah, and I think we'll touch on some of the asset allocation implications of this in a moment. I think one thing to mention is that we ran this survey period around September, October time, and that seemed to be the time when there was this peak narrative around higher for longer interest rates, which perhaps have cooled a bit in more recent weeks with some of the softer inflation data we've seen. Although, yeah, it maybe suggests just how much some of these funds are having to react to the latest data right now in this uncertain environment. Abdul, I'd like to bring you in on this as well. What are you seeing in terms of at FAP? What is the key macro concerns that you have right now?
Well, thanks a lot, Nikhil, and thanks OMFIF for the invitation. I think webinars like this are very opportune, always, especially in the last couple of years. But I think all of the above, right? In terms of what's important, what's bothering us. I mean, I think one of the recently, I would say, when I say recently, maybe the last 3-4 weeks, underappreciated risks, it is geopolitics. I mean, you have the situation in Europe, the war in Europe, and obviously in the Middle East, a lot of the tension going on there. And I think when I say we, folks that invest in North America and the U.S., we sometimes are a little bit desensitized from these kinds of risks. So I think that I wanted to start with that because I think that's something that is ever present, and it only rears its head every so often. So that's always a concern because it's just very difficult to handicap that, and what does that mean for your portfolio. And the issue of rates, rates and inflation, clearly that's important. I mean, I think I think your report mentioned how folks are looking at their portfolios relative to what happened in 2022, which is not hasn't even been a year yet. It's hard from the standpoint of we're supposed to be long-term investors, but we are kind of looking at our screens every single day. And so I found that very interesting, where folks are focusing on the losses of 2022 and how long is it going to take to recoup that. So are we. I mean, we're not immune to that. We're happy to report that we probably have made up 80 to 85% of those losses. But again, it's this push and pull between long-term investing and the headline risk, which we are also affected by. So I mean, there's a whole bunch of other things that we could get into, but right now those are the top two things that come to mind. Making sure that we remain long-term investors through.
Yeah, thank you. And Jahangir, turning to you, perhaps just picking up on that point. I mean, how are you advising your clients who are pension funds and sovereign funds when they may be wondering about what's going on in their trading screens today, when they obviously have long-term investment strategies? How are you trying to manage that?
Thanks, Nikhil, for having us. Thanks for this incredible report. It draws out a lot of the key points that we do see from our clients as well. So my first piece of advice would be switch it off, because if you are trying to genuinely build longer dated strategic asset allocation portfolios, the day-to-day moves are merely going to distract you, scare you, and divert you away from them. You have to look beyond them. It's why so much work is done around forward-looking capital markets assumptions and so on and so forth. I think, to your point, when we think about it, we don't think about it as rates first. Rates are a consequence. I think what we see more of is the inflation story is the one that rates are chasing, right? And you have to go beyond, again, inflation from a short-term period to say, okay, it spiked over the last 12, 18 months. The reality is, yes, there was a spike driven by the war in Europe, but the reality is structurally inflation and the world is changing shape as we move away from, you could argue, a 25, 30-year globalization period to a bit more of a regionalized friendshoring, nearshoring process. You are starting to see structural inflation change shape. And so that's where, for me, it becomes quite relevant when you talk about infrastructure, because it's not so obvious if it's just a rate environment, but it is quite obvious for an infrastructure play when you're starting to talk about, okay, what inflation hedge instruments can I start putting in place? And I think they become really interesting. Now, consequentially, what we have seen a lot of people do is go into the more sort of private markets, more longer dated instruments. But actually, as we're seeing, when rates go up, that challenges the business model of some of, I will say, some of the more geared private equity houses. And that's where you start seeing a little bit of compression in fundraising and deployment on the private market side. So I think you've got to look beyond just the rates and say, what are the drivers of rates? And that's got to start coming into structural changes in inflation, structural changing in global markets. And you need to overlay that into switch off Bloomberg, switch off CNBC, and start creating longer dated future looking assumptions around your asset classes. And so that's how we think about it. That's how we lead discussions with our clients. And I think that kind of tries to frame them. That said, there are pools of capital within our clients that are TAA focused or tactical asset allocation focused. And of course, they're trying to take advantage of the shorter moves in the market.
Yeah. I think again maybe we can come on to that point on particularly on infrastructure in a moment. Mark, I want to bring you in here on well, if you've got any follow up on some of the points that were just discussed around interest rates and geopolitics, and then I want to come to you to talk about climate change and where that factors into this, and whether that's something that these funds should start to take. Well, they are starting to take it seriously, but is it an underappreciated risk for them? But maybe first on the rates and geopolitics.
Sure, I'll take the rates and geopolitics. I mean, Goldilocks scenarios kind of worry me a little bit. So we've had this textbook response to inflation from central banks. So we've had rate rises. We've seen inflation, what appears to be peaking and falling. If you take the European experience, headline down at 2.4%, that kind of masks a few sort of discrepancies there. We've got Belgium, I think, on one end with negative inflation, and you've got Slovakia at the other end with inflation almost hitting 8%. So I think all is not well when you delve behind. But I think central banks have probably done a pretty good job at least that initial response. I think really the challenge is to make sure that you don't get any secondary inflation, that nothing sort of picks up and starts to get that inflation higher. So I think some of the things that we would look at is to see whether wage price inflation continues on the up, whether services are sticky or actually indeed falling. And I think what was pretty good about the falls in Europe were that you saw both food price falls and service price inflation fall. So both of those, I think, are pretty good. So from a sort of an investment point of view, if you look at the long end of markets, bond maths have changed. So for anybody who was investing when yields were 1% and 2% at the long end, you just don't have that yield cushion. What you now have at longer end of the markets, where yields are, depending on the market, sort of 4.5%, 5.5%, you've got a really good income protection against further fall. So the bond mass has started to flip. There isn't symmetry anymore at the longer end. So I think the longer end of the market does bear looking at. There are some really attractive credit plays as well. If you go further down the credit curve, you're getting some good returns in asset-backed securities, for example. So again, if we can engineer that attractive slowdown where growth remains pretty much on track, albeit slower, then I think it's a pretty good background for capital markets in general.
Okay, so perhaps some optimism there. It was interesting when we did our survey, it was pretty much a 50-50 split between those who said they expect a recession or not. So I think that the jury's still out, at least from those we surveyed, whether we do get this benign disinflation and a soft landing, really. I suspect that's something that the central banks are still trying to, are wishing for. Whether they get there or not remains to be seen. Abdul, let's pick it up back with you on that point about government bonds. I mean, as Mark mentioned, yields are around 4 or 5% on some developed market government bonds. Is that looking attractive for you? Are you looking at this as an opportunity to bank some attractive yields, or are you still worried about the potential further rounds of inflation or central bank hikes?
Right. So clearly the bond math, to use Mark's term, has changed dramatically, and you certainly are seeing a lot of juicy quote unquote opportunities in the market. Now, the way that we do our asset, we have both, and to Jahangir's point, we have both strategic asset allocation and also tactical asset allocations, which by definition, is more short term. So we tend to look at things in an 8 to 10 year horizon. That said, I mean, I think if folks out there put themselves in our shoes as asset allocators, we're all terrified and scared of another 2022, which means stock bond correlation, right? So you have to see the stock bond correlation go high, in the negative direction. It is something that we want to avoid. So while I think rates, interest rates, and bond yields specifically are pretty attractive, like anything else, if something is attractive, it could also become much more attractive later on, and therefore you have to as you're creating and structuring your portfolio, you have to be cognizant of that. So yes, we do see some opportunity, clearly, on the same, and it's all linked, with interest rates, but clearly, private credit, which is, these are bonds, they just happen to be, private. It's an asset class or sub-asset class that continues to be attractive. I do worry about what I call the bubble in terms of the availability of capital for capital raising, and so you have to be sort of very careful there as well. Even though some of the yields are very attractive, maybe 300, 400, 500 basis points above some of these more stable bonds. You have to sort of be careful, because at the end of the day, everything is linked to interest rates, as I've said. And the consensus is, I think, that rates will stay longer for a long time, but we don't know how long. And as long as that continues, there's some companies out there that just not, they're just not going to be able to service that, that debt. So yes, the things are attractive, but like anything else, we have to be strategic long term and just be a little bit careful.
Yeah, thank you. Yeah, I was gonna ask what are areas that you're perhaps looking to diversify, and private credit being one you mentioned. I think you mentioned ABS before as well. Torbjörn, sort of similar question to you. Are you starting to look towards alternative assets as a means of diversifying, or how are you thinking about your asset allocation in this current environment?
No, overall, I think we have a fairly well diversified portfolio already, as diversified as it can be, given circumstances, and also our regulation put some limits on what we can do. But our portfolio have three very important legs. We still have a significant allocation to listed global equities. We have a somewhat significant allocation to fixed income. And we do have a significant allocation already to private assets like private equity, real estate, infrastructure, and timberland. I think what will weigh in is that I'm concerned that we have more of a structural problem of inflation. I think clearly we have seen a strong cyclical uptrend in inflation, and now we see a strong cyclical downtrend in inflation. But I think the structural forces around the inflation have completely shifted throughout this decade, and probably for some time to go, compared to the previous 2 decades where we have seen disinflation.
Could you give some more context on that? I mean, what more specifically are the drivers that you think have driven inflation structurally higher? Is it some of what Jahangir mentioned about the reordering of supply chains and deglobalization?
Yeah, I think the very spike of inflation over the past 2 years is, of course, strongly pandemic related and stimulus related around that, and of course supply factors like disrupted supply chains and other bottlenecks. But I think this was already in the making before the pandemic, to be honest, because the strong disinflationary factors were already diminishing. Like we really stopped the globalization. We were on the path to sort of take rates up a bit before the pandemic as well, and I think we learn now that low rates does something to fight disinflation, but it's also actually feeding low inflation in keeping excess capacities in place, for example, when it comes to different industries. And of course, the strong structural factor now pointing to higher inflation are basically two. I think there are demographics. There is a real shortage of labor coming up, and we are in the middle of the beginning of that. And I think the other factor is paying a fair share for all external costs related to climate, stable supply of food chain and healthy access to water. I think those factors are structural forces pointing in the direction of inflation.
Yep, thank you. I would suggest to everyone very kindly contributed an article on the impact of demographics for our bulletin series a few months ago. So yeah, be sure to check that out on the website as well, which goes into that in a bit more detail. Jahangir, coming back to you on, I think you already preempted this before about in this higher for longer environment and understanding the reasons why inflation's gone higher. Maybe infrastructure looks attractive in that environment. Are there any other asset classes that you're thinking of that would make more sense right now? And are you advising your clients to tilt out of other asset classes?
Look, it really does depend on the type of institution you are and where your starting base is, right? I mean, there are some of our clients who, on the sovereign space, are starting to tiptoe into the private markets, where you need to add that because it's a diversifier to your portfolio. The scale of private markets as a component of total market has grown, so you need to have that exposure. It's an operating advantage, and then an element of private credit. People think of it as a completely different animal. It's not. It's been a consequence of 15 years of regulatory change post GFC. There are instruments that were available in public fixed income markets that are today only available in private fixed income markets. The syndicated loan market has been really picked up by private markets. Private debt placement instruments have moved into the IG space. So it really does begin. The conversation is where are you, and as a result of it, what diversifiers can we bring into your portfolio? So it's not a black and white answer.
No.
If we're then looking at public pension funds, they have a very different story. They're coming in from a very different environment, and that is that many of them had facilitated liquidity to their members throughout COVID. That created quite a liquidity squeeze on them. If you look at the UK public pension market, well, we all know what happened this time last year. We created an LDI squeeze that put them in a very different environment. So again, the types of client, the types of liability that they're servicing requires a very different discussion. But on the whole, if we're taking, a lot of the public pension funds are, let's just for the moment say, are emerging market based. Well, even if you are UK based, which some would describe as emerging market at the moment, we're having to think about how do you get diversified but global exposures. In the case of UK, ironically, we're probably at one of the all-time lows in terms of public pension funds being domestically invested. So you see a lot of policy from government trying to incentivize and encourage bringing money back to the UK. And we've seen some of that in developed markets. But actually, when you're talking about emerging market pension funds, we're encouraging them to seek opportunities outside their own boundaries. Why? Because they're starting to create asset inflation in their own domestic market. Right. They're pumping too much liquidity into their own domestic market. They've become owners of 60-70% of their bond market because that's how they financed it through COVID and prior to that. Or they were getting excited about their domestic yields, and there's this home bias notion. Yeah. So it really, lots of different answers there, Nikhil, but those are some of the things that we would think about, but there is really no one size fits all on what should I buy tomorrow morning.
Yeah, I think that's given a useful overview. I'll come back to you on how to think about regional allocations in a second. But Mark, I'd like to pick you up on some of those points that Jahangir's just raised. And yeah, any thoughts or comments on that? Are those things that you probably agree with?
Yeah, sure. Well, I can't believe we've got this far into a conversation in this day and age and on the eve of COP without mentioning climate. So I'll probably address it from that point of view. I am actually sitting in Dubai as we speak, and obviously COP has kicked off and is creating quite a lot of good and positive news, which I think was probably not on the cards if you looked at the or listened to the pundits about a week ago. So I think that's a nice positive. I think from our point of view, we've had a perfect storm, I think, for some of these private assets. So perfect storm from the point of view of rising rates and also inflation. The great thing is that's now a known quantity. So in a sense, that's in the market. And I think what we've seen, certainly in the energy transition space, are a number of quite public, large contracts being pulled back from, the likes of Vattenfall and issues with Ørsted in North America. And I think a lot of those are just that sort of dislocation between having a 15-year offtake agreement that's linked to RPI, for example, or CPI, and then finding that your cost structure isn't going up in line with RPI or CPI. Your cost structure is going up with the specifics of the industry you're in, and that's creating that negative sort of scissors, effectively. We've seen governments respond to that. So I think if you look at the UK, when people talk about the failed auction for offshore wind, if you notice, they've actually come back and said, well, we've looked into this and we're increasing our auction prices by 66% in the next round. So I think you can actually start to see that there is this recognition that there have been some cost pressures, that rates are higher. You have seen valuations, and if you look at the investment trust market, where you can get a sort of a more accurate mark to market as opposed to private equity, where the mark is not as frequent, you've seen those adjustments coming in prices as well. So we're sort of looking at that market and thinking that a lot of that bad news is now sort of in the market and in the price, and there is an opportunity there. And I think what we would argue is let's just be careful how you're deploying your money, because I think just going blindly and adding to your previous infrastructure manager, you might be missing an opportunity. I mean, the existential issue here is the huge amount of investment that we need in the energy transition.
Yeah.
And I think just going for your old manager, and hopefully we'll come on to this a little bit later, so I'll kind of pause, but just looking for that manager that did toll roads and airports and gas pipelines, I would hit the pause button on that for the moment. But I think we'll come on to that hopefully shortly.
We'll definitely pick up on that point on the energy transition, which is a big thing that we explore in the report. I think just taking a step back actually, and considering the barriers to investing in private markets. It's already been mentioned by a few of you on the opportunities in private credit, in infrastructure, and the renewable energy space. But I want to pick up more about what are the barriers here. I mean, from those that we surveyed, illiquidity, perhaps unsurprisingly, was one. Another was valuations. I want to start with Abdul, and then maybe I can come back to you, Mark. You'd mentioned private credit earlier. What are you seeing as the main hurdles to you investing more in private markets?
Well, two observations, right? These are more practical. One, if I go back to my comment about 2022 and how scared we are. If you look at, not all of us, but some asset allocators have 80, 85%, 90% of the portfolio in both stocks and bonds together, including cash. And that obviously did not work. So I think it did not work in 2022. So I think from that standpoint, that causes you to go back and think, okay, how do I diversify this portfolio a little bit better? And clearly the answer is alternative, but that means a lot to a lot of people. If you bucket it in four general baskets, you have private capital, which is private equity and private credit. Second, infrastructure. Third, real estate. And then the last leg would be hedge funds generally. Some people might combine infrastructure with real estate, which is fine. So maybe it's three buckets, not four. But so there is this internal pressure, from boards, from the executive team, from ICs, investment committees, to see how we can we can reallocate and sort of shake up our asset allocation into alternatives. So the number one sort of barrier, I think that was your question, is clearly access to good managers, and I would say the second thing is the liquidity that they provide, and liquidity kind of cuts both ways. Just think about the equity markets, right? That's very volatile. But there's a lot of challenges, especially for folks and for funds that are new to the to this sort of investing. Is okay. So how do I account for these assets that you don't really get information, maybe quarterly, sometimes maybe monthly, but sometimes even with less frequency. So that clearly is a challenge. And then how do you access? Let's focus on infrastructure. How do you access infrastructure? You go to a manager that does just energy, or do you go to a manager that sort of a fund-to-fund structure where you can just diversify in that way and sort of mitigate your J curve? So that's sort of one way to look at it. The second observation that I bring, I think we all saw the news, and this has been going on for quite some time, but the Norway fund is keenly interested in investing in private capital, and obviously in private equity specifically. Yeah. And clearly that provides a lot of impetus. It puts a bid on the asset class, and for sovereign wealth funds like ourselves, obviously we're sort of a rounding error next to their size. We're going to be looking at them for guidance and standards and the way that they manage the asset class. So who knows? I mean, we're probably on the cusp in terms of private equity investing, where things are going to look a little bit different from asset allocator standpoint. Yeah. As this fund starts to deploy. So I think the comment is, I think that sort of action by them, by the Norway fund, I think puts a bid on the asset class, and also the renewed interest in it.
Yeah, interesting. Yeah, to your point, actually, I think maybe not got the size, but as a big fund in the Nordics, how are you thinking about private equity and possibly the hesitations around it, or private markets more generally? Abdul mentioned illiquidity being one, or trying to access good managers. Are those points that resonate with you as well?
Yeah, absolutely. I was thinking about your initial question with what are the hurdles to be maybe a more significant infrastructure investor, i.e. an investor in the energy transition. And I think they are clear. We have been doing this for some time, i.e. infrastructure investments, but I don't think we have found the right or the great model yet. I mean, one model could, of course, be how we do private equity, but that's very different. We can diversify away basically specific manager risk. We have 50 different GPs, and we are probably invested in 200 different funds. So you hear it's an approach of extreme diversification almost. Should you do it in the same way when it comes to infrastructure? I don't think so. I don't think infrastructure should have the private equity setup, which they very frequently do, i.e. a similar fee structure and a similar, maybe slightly longer life length to the funds. But I think both those two aspects should not be at all in line with how we do private equity when it comes to infrastructure. And I don't think we should have this extreme diversification approach. Infrastructure entails completely different risks. Two great examples are geographical risks and political risk. And the other or third one would be complexity risk. It's completely different from doing private equity, which in a sense is more generic. So my main point is that infrastructure is a lot more difficult.
Right. Yeah. Interesting. Maybe just to move the conversation on slightly away from the private market space, but to come back to that regional point. And Jahangir, want to come to you with this one on. You mentioned diversifying regionally, but I wanted to just pick up more specifically when we think about emerging markets. So, and this is something that came across in your contribution with Neuberger Berman about how funds should maybe start to look to reallocate towards emerging markets. What we saw is from those we surveyed is India seems to be the most attractive right now. That's something that was mentioned not just in our survey, but picked up in GIC's contribution. Future Fund mentioned that they're looking to reduce their exposure to China, again, which is something that was found in our survey, is issues around regulation and geopolitics. Where do you see value right now in the emerging market space? You sort of do those survey findings resonate with you?
Look, a very difficult question to answer. Because one of the fundamental issues at the moment is it's nothing to do with the emerging markets right now is the reason why you don't have the fund flows to the emerging markets. In fact, the fund flow out of the emerging market is the trend and has been for the last few months, quarters, maybe even couple of years. And the fundamental driver of that is when you're picking up 500 on risk-free treasuries, that really makes the emerging market discussion very, very difficult in terms of portfolio allocation purposes. But at the same time, if I sat there and I looked at it from a fundamental values perspective, if I looked at it from Torbjörn's point around demographics, if I looked at it from forward-looking growth story, I would allocate to emerging markets all day long, right? I mean, and that's the dichotomy that you have is trying to manage forward-looking growth versus what the current market environment is and what that is forcing. Do you reflect that in your TA or in your SA? So one of the things in our paper that you will see is we do encourage the adding on emerging market risk. Again, it depends, right? It really, really depends because some of the investors we see have been running at sort of 5 to 10% ranges on their EME and EM debt holdings. Some would argue that over the last decade, the debt has been a much more consistent way to generate return streams out of the emerging markets at a lower drawdown and standard deviation than the equity tranches of it. But at the same time, I think going to Torbjörn's point, if I'm looking at developed markets and I'm thinking demographics are worrying me, immigration's worrying me, structural inflation's worrying me, well, actually, let's look at the Asia inflation story. Let's look at where Latin America is at the moment. These are in really, really good places. And Latin American central banks, hats off to them, right? They led us into raising rates before the developed world did. So, you know, we've seen really, really good structural reform. We've seen really good place that inflation's been in a really good level, kind of manageable levels in Asia. It's being controlled ahead of developed markets in Latin America. But at the same time, dollar at 5, I'll hold my dollars right now. And that's been unfortunately the not emerging market story. Right. Torbjörn, you're nodding your head, so I presume you're grappling with the same issues.
No, for sure. I'm more so. Well, to take the background story, AP3 was never a big emerging market investor for traditional reasons. I think there is also a backstory that we thought that the global business cycle were affecting the Swedish global companies massively, and our home bias sort of gave us some direct and indirect EM exposure. But I completely agree with you where you're thinking around where risk premia in EM should be and where relative to developed markets and primarily how many EMs have maybe behaved in a more responsible way when it comes to monetary policy, for example. Maybe they're being forced to do so, but they seem to be almost more rational and more long-term than some developed market central banks. Yeah. If you're a bit cynical, so it gives you an interesting starting point from today. My concern and AP3's concern with EMs, it's not only EMs, but we have been trying to find a way to well, filter out the political risk. How do you deal with geopolitical risk today, and how do you deal with those kind of political risks? And we are sort of, I guess, going back to maybe our Western perspective and Western Scandinavian roots, that we find it useful and probably hopefully valuable when it comes to filtering out some of those risks going forward. So when it comes to looking at our global exposure and global investments, we will put money directly in economies that have a decent level of democratic developments, a decent level of rule of law, and a relatively low risk of corruption risk. So we will use those kind of filters going forward to hopefully help us judge the risk of being invested in a certain country.
Yeah, I think that moves us nicely onto the topic of ESG, and I suppose that component touched on the G aspect, but I want to focus a bit more on the E of that and the environment, and come back to Mark on your point you raised earlier on the energy transition. That's again, it's something that was a big focus of ours in the report. We have a standalone section on ESG and a focus point on the transition finance more specifically. And that's something that you contributed an article to. Could you maybe touch on a few points that emerge out of there and where you see the opportunities for investors in the energy transition?
Yeah, absolutely, and probably just recognizing that obviously E is much broader than energy transition, but I will focus in on the energy transition bit, and maybe just loop in a couple of the themes that we've been talking about, because when you get involved in energy transition, one of the big barriers is, and let's leave illiquidity off to the side. I think that's the filter for infrastructure, period. But I think one of the big issues with energy transition is it's a highly complex area. So we actually think investor education is a really good start, because not having a full grasp of what energy transition entails, you're probably starting a little bit of on the back foot. So we actually believe that education is a really big factor. One other thing that's really come to light, and we did an investment management energy transition survey at the back end of the summer. And what we actually found is, unlike global equities, where people might have invest in all markets, but then decide not to invest in, say, Japan, we actually found that managers in the energy transition space were offering often products that were focused on one or two areas of the energy transition, because that's where their expertise was. And so for us, that means if you don't get good advice, you're effectively selling or being sold the story by the manager. So you just have to be slightly cognizant of the fact that the energy transition has some 45 different sectors. And what we've seen historically is the generation side being allocated to, because, for good reason, big projects, technology's been there.
So that's the kind of solar energy wind farm that you were mentioning earlier.
Yes, absolutely. Yes. So onshore, offshore wind, solar being sort of really good examples of that. People came to the party quite early on that. I'm calling that infrastructure 2.0. So your old managers looking at sort of roads and airports, and new managers really looking at that power generation side, or storage in terms of batteries and pumped hydro, or even moving into the transmission side, is how you're actually getting that energy, how you're transmitting that from where it's being created to where it's being demanded. And then the real big thing for us is effectively what we're classing as the demand side. And so that effectively is how consumers and industry are using that energy to possibly heat homes or to actually move around. So I think decarbonisation, that opportunity set, I think investors need to look across the whole space and understand that whole space to get appropriate exposure.
Yeah, I think that's a nice way to kick off this bit on ESG and on the transition and breaking that down a bit more. Yeah, you mentioned it's a complex area, and Abdul, I want to bring you in on that. I know you're maybe just starting out on how you're starting to consider incorporating ESG and the climate transition within your portfolio. Is that a point that's relevant to you? Do you feel like it's quite a complex area right now, and how are you trying to break that down, perhaps?
Well, it's not an easy area for sure. I think, look, I mean, I have several views on this. The issue of quote unquote ESG. Obviously, the term itself, has been, top of mind in North America, the United States. There's been a huge political backlash on the term and what exactly it means. Clearly, has chilled a lot of initiatives, some funds, even, and so to be very direct, the issue has been largely on the S, the social aspect, and so we're not immune to that. And from the standpoint of here, what do we do now? Where do we go from here? I think if I take a step back and I say, okay, let's see what are we trying to accomplish here? This is about energy transition. This is about utilizing less carbon, and so what that means is you have to have a way to account for that. There has to be standards. There have to be reporting, generally accepted reporting standards and accounting. And so I looked at organizations such as the Greenhouse Protocol. They're embarking on an initiative to really get after this, because when you're talking about scope 1, scope 2, scope 3, and for those that don't know, that is just basically a scope 1 is what are you doing? Scope 2, what are your things around your environment that you're doing that affects that, and then scope 3 is sort of customers maybe that are that are impacting the environment. So obviously you have more control in scope 1 and less on scope 3. So when you look at organizations like the Greenhouse Protocol, what they're trying to get at is how do you count these molecules, and I think that's a great starting point for us. And just quoting on your report, I think you had actually Norges Bank Investment Management, the same Norway fund that's going to be invested in private equity. The comment there was, it's about listening to the challenges companies are facing to understand how we as asset owners can be supportive. Well, in order for to manifest that, you have to be able to count. You have to be able to account. You have to be able to report what these emissions are, and that's the big challenge. So yeah. We're still doing things on the margin, and we all want to invest in green bonds, and I have a different way of looking at it. I think all bonds at some point are going to be green. It's just going to be a matter of whether it's mint green or avocado green or forest green. Excuse the pun, because we're going to be able to say, okay, this particular issuer, has done X, Y, has done X%, X% better in terms of their emission, and we know because there's an accounting of those molecules. So it is a tough question. That doesn't mean that we don't try. We're starting with investment policy first. Yeah. But at the end of the day is the whole adage, you can't improve something you can't measure. So this is kind of falls in that area. So I don't have an answer.
Sure. I mean, one thing I would say is it kind of comes back to, again, another finding that we've seen both in the survey we do of central bank reserve managers, which we published earlier the year, the GPI, and this one, and consistently over the surveys the last few years, the insufficient data and information is the key hurdle by the funds we survey, which I think resonates with that point. Mark, it looks like you wanna come in on that, and then I'll come to Jahangir.
Yeah, and it's only a very brief comment, because I know we speak a lot about scope 1, 2, and 3, but we never ever speak about scope 4. Now, scope 4 isn't necessarily totally official at this point, but conceptually,
do we just make that one up in this call? We should make sure we We'll make a note of that.
Absolutely, we'll patent it. No, I mean, I'm sure there's lots of people now just flicking onto Google just to sort of check out what Scope 4 is. It's not been adopted officially by the same people who came up with Scope 1, 2, and 3. But what it actually does do, it talks about the concept of if you've invested in something like a wind farm, you have avoided or possibly displaced something that emitted carbon elsewhere. So in other words, if you were 100% burning coal and now you're burning 90% coal because you've invested in offshore wind, there has to be a credit there somewhere. So I think Scope 4 is trying to capture that, we've done something that is for the good of the planet and really pop something on the positive side of the balance sheet to offset the negatives that we're naturally incurring from Scope 1, 2, and 3. So that's, I think, a really interesting concept that I hope going forward gets a lot more, a lot more traction in the market, because it shouldn't be a pain trade to invest in energy transition. You should get full credit for what you're trying to do.
Yeah,
so I'll stop there.
Yeah, it's interesting. I mean, I do wonder for some of the funds, that maybe the smaller ones, if it's kind of keep adding layers of as what's perhaps required from them. I don't know, Jahangir, what you're seeing from those who you advise and manage money for. What are the kind of key piece of advice that you have if they're looking to integrate ESG into their portfolios?
So I'm going to give you probably a long, boring answer to this, which is the Neuberger Berman view on this, and actually it aligns personally to my view, which is mostly educated by my children who are in sustainability and social economics. So they're way smarter than I am. They are way more focused at the fact that they've got to live on this planet for a lot longer than I am, and they're deeply concerned. And that aligns very much with the Neuberger view, which is this is climate is real. This is a problem. We need to sort this out, and we need to have a philosophy and a capability that allows the clients that we serve the ability to implement. And we're very proud of having some of the largest net zero mandates in the UK market and broader that we're running for institutions in the public sector. And it's something that we will continue to talk about. There are certain investment capabilities in the private equity space. Affecting impact is seen as being much easier. Codifying it into the way we select emerging market debt bonds, well, that's been a part of it for decades. You can't, G is not a new concept. You don't invest in bad governance companies. Simple. I mean, it's to the point that Torbjørn was making earlier around the filters and the parameters they're looking at. The fundamental challenge links a little bit to sort of a briefing that we had with a senior member of the German organization or government this morning, and unfortunately, you saw budgetary rulings a couple of weeks ago by the German FCC, which create budget caps. Look, where's the budget cap going to come from? It's going to come from a funding cut, potentially in sort of some of the climate and transitionary impacts. We're seeing certain pivots as budgets are getting tighter. And growth becomes a bigger agenda in the UK, where Sunak's government is pivoting a little bit away from the priorities in climate. Unfortunately, we're seeing some of this with our asset owners. But we had this discussion a couple of weeks ago. I believe it was at an OMFIF event where, we as an asset manager need to ensure we have the capability to deliver and service where our clients want this. And we have a very clear philosophy. We do not take an approach to exclusion. We take an approach to make better. We are working with our companies that we are equity investors in to help them be better. We have something called the NB votes. One of the few asset managers that will announce how we will vote against a corporate board at an AGM in ahead of the vote itself. We are engaging with countries from a governance perspective when we are a bond investor. We're engaging with high yield corporates. So we're very much an approach at Neuberger, or a philosophy around how do we make companies, governments, and give them constructive feedback to be better.
Yeah.
But we do understand the challenge that asset owners have, where they have a liability to meet. When I think this was touched on by one of my colleagues, when you have to consider the cost of things you have historically not considered, pollution, environmental damage, social impact, governance impacts, there is, some would argue, a qualitative benefit. As a result, it impacts your quantitative returns.
Yeah.
So are people in this forward-looking environment where they're worried about return streams prepared to take that 20, 30, 40 basis point drop in returns to compensate for the qualitative value out of making the world a better place? Now, one of the arguments that I really like is the Australian argument. Well, we're just looking at the wrong benchmark. So I'm not delivering less if you just change the benchmark, which is the legislator in Australia is looking to do or has done, and the European legislator is looking to do. Let's change the benchmark so it is a good benchmark rather than a benchmark. And that way, organizations will slowly not have to justify the alpha they're leaving on the table. But maybe, Torbjørn, you've got more of a view there as a Nordic pension fund who's probably at the forefront of this.
Just before going to Torbjørn on that, I wanted to bring in Elvira, who I think is hopefully still there with us, from ILX to you're an organization who specializes in development finance, but also for the purpose of climate. And I think it would be interesting to get your perspective on some of what we've just heard, and also perhaps to pose a question to our panelists as well.
Yeah, thank you, Nikhil, for bringing me in at this point, and let me also congratulate the OMFIF team for publishing a very insightful report. And may I, just comment on I think 2 topics that were discussed in the report and also in the panel just now. One on the macroeconomic environment and the returns, and indeed on the need for engagement and transition finance. I think a point that Mark makes quite clearly. Obviously, from our perspective, being ILX, a private debt fund manager that invests on behalf of leading pension funds in the Netherlands, like APG, in emerging markets. And we do that alongside multilateral development banks, development finance institutions. So we invest in what we call the development finance asset class, which obviously have an evident focus on SDG and climate-related objectives. And on the first point on the macroeconomic environment and returns, it was obviously stated in the report and also the discussion here, there are geopolitical tensions. There is an elevated inflation and interest rate environment impacting returns quite severely for some of the investors in the public markets. From our perspective, the impact of this heightened interest rate environment is captured quite well in our investment approach, as we are being a floating rate private debt fund. So our co-financings with the MDBs that take place on a floating rate basis, and it in that way serves as your hedge that you like to seek for your investors, and can dampen any losses that they may have in their existing public bull market portfolios. And I just want to point out, this dampening effect that this asset class may have is very much underpinned by the stable adjusted risk-adjusted returns that we've seen in this market for the last 20 years. And that stability in the returns very much comes from the workings of the MDBs that act counter-cyclical, that have a lot of experience, special status even in some of the countries in which they work. To Torbjørn's point, to address the political risks, the complexities that we may all see in emerging markets, working with the MDBs, we feel gives that protection and clarifies much of the complexities that you might see by yourself working in these markets. And that all leads to stable returns, higher recovery rates compared to alternatives. So finally, on this point, also on returns, I think there was a remark also made in the report by one of the survey respondents. We strongly believe that the investors that we have, they do not need to trade to return for impact. In the asset class in which we are active. So this broad experience of MDBs with their safeguards on ESG, on SDG, on credit, enhancing structures, that all ensures that that trade-off in our firm belief does not need to be made. I think data here is nonetheless important. to really understand the actual versus perceived risk by investing in emerging markets. And we always, and on every single occasion that we have, we stress the importance of making more data available here on this asset class. We know that there is this global emerging markets risk database, and we hope that will be become more transparent and public to support that belief that there is this risk perception gap, and more flows need to go to the emerging markets. Final point on engagement and transition finance. I very much agree with Mark, what he said here, but also in the report. I like the quote on transition finance: we need to do more and do it more quickly. We couldn't agree more there. And also that investing in energy transition, I really like that it's perfectly suited to institutional investors that have the ability to invest over longer time horizons. And I think that's exactly why ILX, on behalf of our own institutional investors, match that ability that they have for that longer term time span with investing in assets that carry that longer time horizon. So we invest in solar, wind power projects, we invest in battery innovations, we invest in strengthening networks alongside sustainable infrastructure projects alongside the MDBs, and the engagement that we then need to talk to clients, to talk to businesses that like to decarbonize, that want to provide a more sustainable energy mix to a country. I think that engagement is done by the MDBs, and I think important here to say is they include a very precise use of proceeds in their financing, so we exactly know what the financing is meant to do, what it means to achieve, and it's also being measured. So I think it's a very rich data that we get from these financings that we report to our investors. I'm very excited by the idea of Scope 4. I think that's what we can report tomorrow, because I think there are quite some investments that we do where we can clearly say we replace fossil fuel-based energy by financing and putting solar and wind to the grid. So I think we're ready for Scope 4. So excited to see that the development. So rounded it off from our strong belief that transition to net zero by 2050 means that significant more capital flow should flow to the emerging markets. I'm happy to hear some of the statements about the perception and that policies may have been more responsible there. I think, again, working with the MDBs is your biggest protection that you may have, and at the same time gives pension funds, I think appealing returns, risk-adjusted returns, while also delivering very measurable climate results. So let me leave it at this, and I'm happy to hear what the feel
I was going to say, I'll throw that actually to Thorbjørn. If thinking about ESG, are you considering whether you need to sacrifice return to be able to do that, as perhaps Jahangir hinted at, or do you think you can marry the two up, and that there are opportunities for you in the energy transition?
I'm European and Scandinavian, so I don't really need even to think in ESG terms to consider the environment and good governance and social issues and human rights. So I mean, of course, it depends. I'm being ironic here, but of course, and playing on what people think about Scandinavians, but I of course it depends completely on what issue you're talking about. I am adamant that ESG is not a product; it's not one aspect of things. So I really want to stress that. Sorry.
But if we narrow it down to the energy transition point, how are you approaching that?
Yeah, well, of course, a good example of something that doesn't need an ESG label, right? It's a super important infrastructure investment that we need to do, and of course it's a real investment. It's a real need that the global society has. It's not an invented need, like many of the investments we have allocated money for the past 2 to 3 decades. So I think it's really makes a lot of sense for a long-term investor. It's a real societal need. It has the ability to keep the global economy going for another couple of decades or hundreds of years if we manage to do it. So, and we're starting to find ways of doing it. We have the knowledge, we have the projects, and so on. So I'm super positive and super. It's super useful for AP3 as a long-term investment. Again, not easy. The energy transition is very complicated.
Yeah, thank you. I think we have time for one or two of the audience questions, and I've got one here which moves us back away.
Can I just say something that just real quick? I mean,
question.
I think. Well, the comment is, just given where your yields are on bonds, et cetera. I mean, that provides some cushion for long-term investors to, finally focus on these type of issues, right? Energy transition. I mean, that kind of provides a little cushion. But I also think that, and I like the word. I mean, it was peppered throughout the conversation about engagement. I mean, I understand the, and we don't do this because of our size, but I do see other, big allocators do this. You want to, if there's a problem with a company, I think you're better off being involved with that company than not. I mean, if you're not, in the ring, you can't really affect a lot of change with them. So, and that sort of feeds on itself. And the other comment that I made might be a little controversial, but I think as we engage in this energy transition, which we all agree, I think that it is important. You can't vilify. You cannot denigrate the traditional energy industry, because I just don't think that's productive. And if you look at some of the big companies, energy companies, they themselves are investing in the energy transition as well. So because we still have gas cars and diesel trucks and all these kinds of things. I mean, they're not going to disappear overnight.
Yeah.
So I think that's just something to keep in mind. And I'll just throw it out.
Yeah, no, it's an interesting point. It's something that emerged from the discussions that we had at OMFIF in an event we did in Singapore with the Singapore Exchange, that it's about engagement and getting those more carbon intensive sectors to become more green, rather than just simply divesting from them just to make your portfolios green. I mean, that's the thing that matters for the real world transition. I'm conscious that we're starting to run out of time. I want to get to an audience question that's been there for a minute, for a while. Maybe Jahenga, I'll just throw this to you for a very quick comment. Outlook for UK gilts right now, in 30 seconds.
Tight.
Okay, 2 seconds maybe. Mark, anything on that?
I went long, the long end, PA with my pension.
Okay. Interesting. Well, this is taking less time than I thought. Maybe Abdul will come to you in maybe 10 seconds. Outlook for UK gilts.
No specific insight into the UK market. I think the bond market is again making wonders for your diversification opportunities. I'm not sure about UK. Sorry.
Okay. And Abdul, last word on this?
No comment.
Okay. Well, that was quick enough. Yeah, unfortunately, we'll have to leave it there. This has been an engaging discussion, and one that I'm sure we can continue for many more hours and minutes. But yeah, it's something we'll I'm sure continue to drive this discussion at OMFIF, and use the report to feed on some of these points on the macro environment, on how pension funds and sovereign funds are thinking through asset allocation, and of course this all important topic of the energy transition. Yeah, I'd encourage you all in the audience to read through the reports and to keep engaged with us on these themes for next year. We'll be hosting more discussions and including more content following up on that in the new year. Including in March, where we'll be hosting what we're calling our GPI Summit, where we'll be bringing together reserve managers, pension funds and sovereign funds to discuss the macro outlook and asset allocation, and also a whole day focused just on the transition finance element. So yeah, please look out for that one. That just leaves me to thank my panelists to Chorbon Hanmark, to Abdul Santiago, to Jahangir Acker, Mark Watts, and Elvira Erlings. Thank you all for your time and for engaging with us. And yeah, we hope to see you soon. Thank you.
Thank you, guys. Sure.